Google reported earnings last night after the market closed, and they reported astounding growth. Google Cloud grew 80%, one of its fastest marks on record, and yet the stock is selling off in droves today. What the heck is going on? This actually points to a bigger issue going on within many big cloud spenders, and that's what we'll spend today talking about. My name is Brian Stoffel. As of the time of this recording, I do own some of these stocks. I'll tell you which ones as we go through, and I want to give a shout out to Fiscal AI for sponsoring today's video. Okay, so here's the thing. We're going to talk about 5 companies that are really at the center of this AI infrastructure build out. We normally call them hyperscalers, although that doesn't necessarily always fit that definition. They are Microsoft, Google, Meta Platforms or Facebook, Amazon, and Oracle. Now, what I've done here is I've pulled up the cash from operating activities of all of these companies. Think of cash from operating activities. That's like how we normally think about profits in our family. It's the money that's left over after doing your normal stuff during, say, a year. You can think of it as profits, and it's done on a cash basis. And as you can see, these 5 companies over the last 10 years have been absolute insane cash generating machines. You see up here, the blue is Amazon, the orange, Microsoft, the purple, Google, the green, Meta, and the red, Oracle. Now combined, those companies in 2025 generated an astounding $500 billion in operating cash flow. But here's the thing, there is another part when we want to figure out free cash flow. We have to subtract a number from this. And the number we have to subtract from this are capital expenditures. Now, the way you might think about capital expenditures in your own family is, I might run a family budget and say, hey, our family brings in $100,000 a year after taxes, going about normal business of paying our mortgage, buying groceries, repairs on the car, insurance, things like that. We might spend $80,000, which leaves us with $20,000 left over. Think of that as your cash from operating activities. But sometimes we have to make large one-time purchases, like let's say remodeling a bathroom or a kitchen. And in this case, let's just say, although I know you couldn't actually get this deal, that you decide to take that $20,000 that you had left over, your cash from your operating activities, and spend it on a bathroom remodel. Well, that would be called a capital expenditure. Now, for these players, the Microsofts, the Googles, the Metas, the Amazons, the Oracles, those capital expenditures are basically building out huge AI data centers. Now, I know there is more to that. Amazon, for instance, has fulfillment, and there are other moving pieces, but largely that's the big deal. So if we scroll down and look at capital expenditures, we see that those have been ballooning as well. And note that this only goes to the end of 2025. So this is really important. So let's just think about this for a second. Back in 2023, these 5 companies generated $363 billion in cash from operating activities. And they spent a little under half of that, $149 billion, on capital expenditures. The good news is that they still had over $200 billion in free cash flow. So even after they remodeled the bathroom. Well, at the end of last year, it was starting to change. While the cash from operating activities continued to grow at a blistering pace, $577 billion, we were still sitting on roughly the same amount of free cash flow because our capital expenditures has gone up to $378 billion. And if we look at this on a company by company basis, we start to notice why the market might be getting a little bit nervous about what's coming down the pipeline. Again, using our housing analogy, if all of a sudden we start spending, instead of just the $20,000, we're spending $40,000 or $80,000, well then we've got to fund that somehow. And that somehow of funding it might be taking on debt. It might be issuing equity, which you really can't do in your own family. But I think if we look at this on a company by company basis, you'll understand what I'm talking about. So here's Microsoft. They're probably in the healthiest position. They've got $170 billion in trailing free cash flow, and their capital expenditures are sitting at about $100 billion. So here's the problem with this, though. Microsoft is expected to hit $190 billion in capital expenditures by the end of the year. If it hits that figure, well, then we're going to be looking at a company whose free cash flow is not going to be anywhere near as high as where it is right now. Next, let's look at Alphabet. Now, Alphabet just reported, and they've got $186 billion in cash from operations, which is great. But if we look at their capital expenditures, currently sitting at about $132 billion, but they just upped their guidance to $185 billion in capital expenditures, which means by the end of the year, again, free cash flow is going to be down to razor thin. Before we move on to the last couple of companies, I want to let you know that if you enjoy educational content like this, you'd be a perfect candidate to join Stock Investing Mentor. Now, it comes in a couple parts. One part is live weekly events that are recorded. For instance, we're going to talk about next week this circular financing that's happening within the AI buildup. You also get live real-time access to my real-life portfolio, as well as any explanations of why I make changes along the way. And you get 24/7 access to a private online investing community. I also give you access to my anti-fragile stock universe, where you will be able to see not only all the stocks that I own and all the stocks that are on my watch list, but they are all ranked in terms of their anti-fragility score and their valuation. The other part that you get absolutely free is access to Stock Simplifier. Now, Stock Simplifier is a tool, a $400 tool that we give to you for free, and you can go in and you can check out any company you want, and you can look at several things, which include the business, whether or not it has a moat, its growth, what its key risks are, and valuation. So if you'd like this, if this interests you, simply click the top link in the show notes below and you'll get access to Stock Investing Mentor for 10% off. Let's look at Meta. Right now, Meta's got $124 billion in cash from operations. If we look at their capital expenditures, it doesn't look that bad, sitting at $75 billion, but they've already said that they expect to be spending $135 billion in capital expenditures by the end of the year. Again, this cash from operations can grow, but we're talking about free cash flow that used to be in the hundreds of billions of dollars, now coming down very close to break even. Gets even worse if we look at Amazon. $148 billion in cash from operations, but they're already negative. They're already negative. They're losing money. And they are expected to spend $200 billion in capital expenditures this year alone. And if they do that and their cash from operations only grows a little bit, they will be tens of billions of dollars of negative free cash flow. Now, Amazon has done this in the past, and they can pull their levers to get profitable again. But it's worth pointing out that if you're going to go into this situation, you're going to need to offer debt, which is what many of these companies have been doing. And finally, you have Oracle. And Oracle has, sure, $32 billion in cash from operations, but take a look at these capital expenditures of $55 billion. They've already said that they plan to raise debt and equity next year in order to finance that. So in the end, that's what this sell-off that we're seeing with Google is all about. Look, the market loves the fact that the cloud is growing so much. But just like a homeowner who is all of a sudden overextending him or herself by building more houses, by going into debt, by using all of the cash that they have left over at the end of the year to build these houses, if they get filled, then that's great. And the idea behind that, of course, is that if that demand for AI keeps up, then this all works out. But that does put them in a position of fragility, where if all of a sudden there is a pullback, say a family who said that they would move in all of a sudden doesn't move in, or say a recession hits and all of a sudden you're not able to charge as much for all these things you built as you thought before, That's equivalent to OpenAI or Anthropic all of a sudden pulling back on demand. Maybe Chinese models take away demand. That's not saying that this is a foregone conclusion. It's just that it introduces a level of fragility which is spooking some investors right now. So what do you think about this? Are these investments worth their weight? Will they turn out to be beneficial for these major hyperscalers, or are they setting themselves up for failure? Let me know in the comments section below. Be sure to hit subscribe. And until next time, Brian, out.